There's one other scenario where insider buying makes for an incredibly bullish tell, and that's when a stock has a heavy short position. Meaning a lot of people out there have borrowed shares, sold those shares, and are now waiting for those shares to go lower before they buy back the stock, return them to the bank they borrowed them from, and collect the difference between the price they sold them at first and the price they bought the stock back later. You can think of shorting as like regular investing, only in reverse. We try to buy low and sell high, right? Isn't that what we do? Shorts just turn that around. They try to sell high and then buy low. When a stock has a high short position, that means a lot of smart people have serious conviction that the stock's headed lower. In fact, it takes more conviction to short a stock than it does to go long. Because when you're short, the potential downside is infinite. When you're long, a stock stops losing money when it hits zero. Shorts lose money when stocks go higher, and there's no lid on it, right? The other thing about short sellers is that if there's a lot of them and a stock all of a sudden gets some great news, we get what's called a short squeeze. And it sounds exactly like what it is. In order to close out the positions, the shorts have to buy. This is called covering, short covering. When a lot of shorts cover at the same time in a panic, the stock will surge because what you really have is a lot of people desperate to buy the stock to cut down their losses. A lot of demand. They have to buy unless they want their performance to be wiped out. This process is so predictable that sometimes concerted buyers will foment a short squeeze. Hey, listen, that's what GameStop was all about. That's what AMC was all about. That's what the meme stocks were all about. So where does insider buying fit in the short selling equation? Okay, let's say you have a stock with a high short interest. Then some of the people who run the company start buying shares for themselves. Or maybe an outsider takes a more than 10% stake in the business and indicates it wants more. It's almost like drawing a line in the sand for the short, saying, our stock goes this low and no lower. This is an explosive combination, people, and one that often leads to a short squeeze that sends the stocks much higher. Shorts are smart. In fact, they often tend to be smarter than regular long-side investors, but they usually don't know more about a business than the insiders who run it. If a lot of people are shorting a stock and management starts buying it in sizable amounts, you start doing your homework right then, right now. Really. So usually it makes sense to side with management. Then you can ride it higher and higher in true Jackie Wilson style, higher and higher, lifting me up. As the shorts panic and push shares higher in their desperation to cover their positions, cut their losses, and move on. Similarly, when a company with a heavily shorted stock announces a gigunda buyback, bigger than any previous one, that's another line in the sand situation where management's contradicting the shorts. Companies often repurchase their own shares. And while not all buybacks are bullish, some of them are just outright waste of money. A substantial new buyback in the face of the shorts is often a good reason to take a closer look. Now, a note of caution here. You need to be very careful when dealing with a company that's in the crosshairs of the short sellers, especially when people are nervous and the market's in bad shape. Know the landscape. The shorts have the ability to wreck a stock, even if the fundamentals of the underlying business are fantastic. These days, stock owners no longer have the benefit of rules that used to slow down short selling and make it harder to create bear raids. When I got started in this business, it was much harder to bet against stocks, but the SEC gutted those rules under both Democratic and Republican administrations, all in the name of creating more efficient markets. Without these protections, where you can't smash the stock down, the shorts can easily assassinate stocks, so they smash them down. Anytime something goes wrong. We see it during the financial crisis back in 2008. Oh, my God, that was such a horrible period. And we saw a smaller version of that during the mini banking crisis of 2023. For the shorts, it was like shooting fish in a barrel. So many regional banks traded like they're going bankrupt, but other than a few ne'er-do-wells like First Republic, they were fine. Of course, in recent years, the short sellers have found themselves targeted by bull raids, facilitated by social media platforms, so they have to be careful. But only when the meme stock crowd goes after them in force, and you never know when that's going to surface. These are highly unusual situations, though. You can still find great opportunities in stocks where the shorts have overreached and the insiders are buying. But before going into one of those situations, I have to warn you that the balance of power still favors the short sellers. That means even if the short sellers are wrong about a company's prospects, they can still demolish its stock, especially if they mount highly visible campaigns against the stock. And look, many times the shorts are right and the stock deserves to be slaughtered. Just don't underestimate the amount of damage the shorts can do to the stock. In the end, the best protection against bear raids are stocks that pay good, solid dividends. Because when you short a stock, you have to pay those dividends to whoever you borrow the stock from. That's a terrific deterrent. When you see a stock with a big dividends being attacked by shorts and the yield's going higher, that's often a terrific place to be, especially when the insiders are snapping up stock too. So let me give you the bottom line here. Insider buying plus heavy short interest can equal raging bull buy, as long as you avoid situations where the shorts are determined to crush the stock at any cost.
Cramer mentioned something that has been plaguing the financial markets for well over a century: large firms establishing massively over-leveraged short positions in the stocks of companies they dislike, and then doing whatever they possibly can to drive that company's share price into the dirt. It would be one thing if someone went short on a stock, someone else went long on that stock, and we all played by the same rules. But over the past century, that has not been the case, not in the slightest. Notorious short sellers have oftentimes engaged in short and distort campaigns, engaged in naked short selling, used the smash and grab strategy, hidden short positions from the public via derivatives, hidden short positions from the public via certain ETFs, and the list just keeps on going. And then, as we saw in January of 2021, when individual investors finally called short sellers bluff, they simply changed the rules to favor the large firms and institutions, and regulators did absolutely nothing about it. Regardless of what you may think about GameStop AMC or any other company, the reality is that the problems that these companies' stocks have brought to light go far beyond just these stocks. The problems these stocks have brought to light affect thousands of stocks, thousands of companies, thousands of employees, millions of shareholders, and billions of customers. Over the past century, some of the large firms on Wall Street have used everything within their power to crush the stocks of companies they disliked. Naked short selling, short and distort campaigns, hiding short positions, etc. What's interesting about the events of January 2021 and following is that now, notorious short sellers must be much more cautious when targeting companies they dislike, because now millions of individual investors are involved in the financial markets, doing their own research, supporting their favorite companies, and advocating for substantial change in the financial markets. As individual investors, what we want is simple, and nothing we're advocating for is beyond the realm of reason. Individual investors want a free, fair, and transparent stock market. We want large institutions to be held accountable for their actions. We want individual investors to have access to the same real-time data from exchanges' better private feeds, which is currently only available to the large firms on Wall Street. We want short sale data to be reported in real time. We want an end to excessive amounts of failures to deliver, and we want entities who fail to deliver on their obligations to be held accountable. We want an end to payment for order flow due to the insane conflicts of interest it creates. There's a reason why so many other countries have already banned it. We want the exchanges to be not-for-profit utilities as they once were. The exchanges becoming for-profit ventures has created so many conflicts of interest at the expense of individual investors. We want increased competition among market makers. And we want all of individual investors' orders to be routed directly to lit transparent exchanges rather than opaque alternative trading systems known as dark pools. Ultimately, it's simple. What we want is a stock market that offers a truly level playing field for all investors. Please leave a like on this video so more people will see it. And while you're down there, please consider subscribing. It's free, and you can always change your mind. You can also find Finvid on the new Finvid Rumble channel. Please go follow us over there in case anything happens to this YouTube channel. Thanks for watching, and hopefully I'll see you in the next video.